Hello, folks. Brandon Chapman with you today. It's another video on a Monday. It's September, and boy, it's supposed to be the bearish month, right? We've got stocks. If we look at the market right now today, the S&P is higher on the session, 1.12% on the SPY. So the S&P surges as shiny objects distract. What are those shiny objects? Well, we look at companies that are set to be added to the S&P 500. Palantir Technology. Boy, that stock's up 14% today. All because of what? An addition to the S&P 500 that really yields no value to the stock. And half of these companies, we look here, we got Dell, we got Erie, Indemnity, American Airlines, Etsy, and Biorad Laboratories. I mean, look, and this is not necessarily an exciting day, except for, I guess, if you bought Palantir on Friday, you're feeling pretty good about yourself today. But as we look at the market again, what's happening is we're getting distracted by shiny objects. And of course, look, I mean, when you have a bigger sell-off like we had on Friday, usually the buyers of last resort are the short coverers. But when you look at stocks like Palantir and you look at Verizon, it certainly seems like, or appears, we're outstripping just what might just be a short covering type rally. And so as a function, our bull's getting sucked in right now and really setting up for a bear trap. Right. So the idea is, General Dynamics was up nicely, maybe even a breakout today. You kind of go down the list. AMD, not honestly all that exciting there. AXP, not really an exciting rally today. But again, we're making back a lot of the losses we saw last Friday. And if we're to characterize last week's selling, it was the biggest sell-off in the S&P 500 since Silicon Valley Bank. It's been a while since we've experienced any kind of volatility to that extent. Obviously, we had the 65 VIX, but I mean, in general, the amount of selling we saw last week, it was the most bearish week since Silicon Valley Bank. So you look at a lot of these names in here, like a Broadcom, for example. I mean, yeah, it looks like a dead cat bounce today. But then you look at others like Verizon. Well, what came out with Verizon today? I mean, what news? I mean, seriously, they're getting close to the sealing the deal with Frontier Communications. Well, didn't we just get the announcement back on the 4th and the stock dropped precipitously? And we didn't even make that back today. Again, going back to Palantir, what's changed that makes the stock 14% more valuable? Well, if you look at stuff like live news out there on Palantir, everyone's pointing to the addition on September 23rd into the S&P 500. But what makes the stock more valuable? It doesn't, right? So the idea right now, we're as a market, right? The bulls are suffering from shiny object syndrome, right? The idea that something flickers, I'm going to go for it, right? It's like, saying squirrel if you're a dog, right? Squirrel. We're looking, right? We're trying to find. And right now, the bulls are chomping at the bit, wanting to join. We've seen rotation, funds, even individual traders, some data coming from Bank of America, suggests everyone was selling last week. So the point is, why are we chomping at the bit to get back in today? Is this just kind of a bear market rally or a bear rally, a bull trap or bear trap for the bulls? And so we look at today's price action on the S&P 500 during the cash session. Basically today is what? It's a harami. We have a long bodied candle here, we have a short bodied candle finishing in the range. This is a day of indecision. Now, if we follow through tomorrow, it's going to be a bullish bounce. Well, how far are we going to get? Are we going to get back to prior highs here at 563 or higher? Are we poised to test new all-time highs in the coming months against the headwind of a September that's historically pretty bearish for the market? Against the headwind of the Fed potentially cutting 25 or 50 basis points because of what? Because of economic weakness. Now, we do have some potential this week for volatility. For example, we look at some of the data. We got CPI coming up on September 11th. We got PPI on September 12th. Certainly, there's some stuff that could be put in the punch bowl here that may upset the market and upset rate cut odds, especially if we come in hotter than expected, either on the headline or the core, both expected to be the same for CPI. Well, one of the things that's helping CPI is the fact that oil prices have not really held up all that well. Look at forward/CL, right? So CLs continue to see the downward slope. And yet, if we look at inventories, my goodness, we come into the EIA report. I looked at this early in my session, but we're at the 5-year low right now in terms of oil inventories. Why is oil slumping off? I mean, today, even on some of the news, right? We're talking about Gulf. We're seeing storms come in, may have to put off some production. Shouldn't oil prices be finding some level of support and maybe surging here? Certainly geopolitical risks. We have undersupplied nature in the United States. We got all this stuff going on, and yet oil prices remain suppressed. And the product itself, look at CL, we're in backwardation. This is a bullish condition for oil. All this stuff setting up, and yet oil prices are falling. Why? We got to be looking at recessionary type pressures playing out right now. Fed maybe going 50 basis points. Isn't that recessionary? The jobs report last week, isn't that somewhat recessionary? The weekly jobless claims. There's a lot of indicators flashing red right now, and yet what happens today? The bulls step in and buy, maybe again, predominantly short covering. But when you look at Verizon, you look at Palantir, those are two companies that really highlight the fact that, again, shiny objects attract. And one of the things you know about shiny objects, look at it before you put it in your mouth. Okay? Just take a quick peek and say, oh my goodness, is this something I should be putting in my mouth? It's shiny. I'm holding on to it. I'm attracted to it. Do I put it in my mouth and eat it? You're probably going to get sick. Okay? So right now, what we have is we have a condition in the market that people are wanting to step in and buy. But what I'm suggesting is take a measured response right now. I mean, look at the VIX. The VIX is still at around 19.5, right? We're talking about significantly higher expected volatility. Now, the one kind of side note on the VIX is the fact that if we look at the VIX futures, we're kind of sitting in a backwardation. So while backwardation is bullish for oil, backwardation is bearish for the VIX and bullish for the market. But this is a very slight backwardation that's going on right now. This has been in existence since early last week. And so what I've kind of encouraged those that are in my sessions is, look, don't get too attracted by it. This is not a shiny object because we went too quick, right? We escalated to the point of suggesting volatility has declined too early. And as we look at the 3-month to 1-month ratio here on the VIX, what you'll see is we're not below 1 yet, but we came really close on Friday. Okay, we're really, really low at saying, look, right now we're looking at 3-month and 1-month volatility. We're expecting similar amounts of volatility in the near future. We look at skew. Skew on Friday made a big move lower. Well, skew's coming off a level of 163, almost the highest we've ever seen in skew, right? The market is guarded. We'll see where the skew goes today. Maybe it declines. Maybe it ramps back up again. Okay, seeing the direction of skew is going to tell you whether hedges are being dropped or added today. Okay, by virtue of buying puts and selling calls. But a skew at 163 early last week, it told you, look, you've got to be careful, right? And one of the things I talked about on Friday in my session, we walked through a hedge back on August 18th or 16th back here. We walked through the notion of, look, taking profits, putting on a hedge. That hedge at 544, that put went in the money on Friday. And we talked about the idea that, look, the best way if you want to add positive delta is to take that put that has basically mitigated almost all of your directional risk and just move it further out of the money, like to 530, for example, a 30 delta, 30 days out. That's the best way to add delta. You're still hedged, but if the market rallies like today and we rally and we continue to rally off the lows, guess what? Your hedge will just move further out of the money, amplifying your bullish delta. But is today the day to go out there and buy a bunch of stuff after Friday's selling? Well, the S&P is up 1%, right? Verizon's up 4%, Palantir's up 4%, 14%. Are you trying to buy these breakouts? Okay, you might want to pull back and say, look, I want to see something. I need a little bit more. And in the case of this kind of flat volatility curve in the VIX, what you may want to see is this starts to get normalized, more of a positive slope as we move out in time. You may want to look for more confirmation. And you can say, yeah, but I bought on the 5th or I bought on the 7th, the 6th last go around, more like the 6th. I get it. You maybe did, but here's the deal. How often do we see that kind of V-shaped recovery? Almost never. And the fact is we may not be done yet. You know, stocks like Google, I mean, you compare Palantir and Google and you think, wow, this company's actually trading at some modicum of value. It's down, from 190 to 150. I mean, that's 40 points, right? That's over 20%. And yet I look at the breakdown here, the seed wave and the projection. We broke this 61%. I'm looking at 130 on Google, right? Wake me up when we get to 130. Be patient. You don't have to rush out there right now as the market's starting to sort out. Are we going to recession or are we not? Today is simply what? It's simply a short covering rally. Look at high beta names, SPHB. This is an ETF that tracks the 100 highest beta names in the S&P 500. It's up 1.5%, outperformed the S&P 500 today. A lot of these names have what? They're either in technology mostly. They may have high short interest and other factors, right? What's happening right now, technology's been the worst performing sector. You can see we're down 6% in the last week, and that's including today's bounce of 1.6%. Okay? They're covering their shorts today. So don't get necessarily caught up in the fact that I don't want to miss the next rally. The probabilities of a next rally, well, look, skews high. You always have a better than a 50-50 shot of the market going up the next day or the next week, right? High skew tells you we kind of climb the wall and fall off it, right? We kind of climb up the stairs, fall out the window. The downside risks right now are extreme. So again, do you buy after the stock of the market's moved up 1%? The fact is we probably want to see the VIX get a little bit higher, right? It's not going to go to 35 likely or even to 65 unless something catastrophic happens. But could we take out the high here around 23? Absolutely. It's just going to take a little bit more of an unwind to really push this thing to the downside and provide a better value, right? I'm like, if you don't buy here, are you missing out? We're barely off our highs right now, right? And yet we feel like this pressure, I've got to do something, right? This is the best value I've ever seen in the market. No, it's not, okay? We're down off of the highs. I think we're down a total of a little bit over 4%. So I'll click here and we'll go down to the low and we'll check it out. Just got to move this down. But we're down 4.6%. The signal that we got back here on the 16th of August was for a 5 to 10% correction. We're barely on the outside of that right now. This similar type of signal we got before this correction here. So this is where if you are hedged, if you're consistently managing your expectations, you've added some delta by virtue of your roll on Friday if you thought we're going to bounce, or you're holding onto the hedge in lieu of going lower. But you had a chance very easily to raise your portfolio beta weighted delta by just rolling that put down. We walked through a 544, rolling it back down to 530. You're still hedged. You're still protected. You had a chance to take off the call spreads that paid for it. And again, you're locked and loaded if we keep rallying. But that's just by what? Reducing your hedges, right? Which increases your delta. If the market goes down, those hedges are going to re-engage and cut your delta quickly as the market declines. But right now, what is it? This is about sitting back and watching what happens. Okay. We start to test prior highs, break out to new highs. Okay. Maybe as we get more confirmation down the road, but right now the risks are elevated. And again, the shiny objects are going to attract you. They're going to want you to suck you in and say, you're the fear of missing out. But remember, this is like the guarantee fairy in Tommy Boy, right? You rush out there, you buy the high beta names, you think it's buying and rather it's short covering. Even look at biotech. I mean, IBB, we put a bearish trade on, or walked through a bearish trade at the highs up here. We took it off on Friday. We're getting a bid today. Well, biotech is the highest short interest area of the market. So yeah, we get a nice bounce back today, 1.25%. Is it poised to go 20% higher from here? Or is this just the shorts taking profits and we're mistaking it for something bigger? The point being is it's very, very difficult at this stage to really know what's going to go on. And so again, sometimes the best thing you can do is not do anything. Let's look at Apple. Apple had its unveiling today, right? Stocks off the lows, was trading a decent amount lower. We finished basically unched on the session. We underperformed the S&P 500. The iPhone 16 was kind of a dud. No major updates or changes. There's an AI that's not as good as other AI platforms out there like OpenAI. They're going to roll it out incrementally across devices and phones, maybe a slight increase in price on already very expensive devices. Again, right now, Apple, are we poised to see an advance or decline off of this level? I mean, it wasn't exactly well received after the market hours. We're not seeing really any additional upside from here. We just basically round trip twice intraday to finish unch on the session? Are you attracted by the shiny objects of saying AI and incorporating it in a phone? Even as that we're looking at other AI platforms, we're seeing decreasing adoption, right? The traffic to some of these sites have actually gone down rather than up. I mean, how many poems are we going to write? Data we're going to check. But anyway, point being is that, look, I mean, there's a lot of shiny objects out there. Nvidia today as well. Are you going to get sucked into Nvidia and think that Nvidia is now somehow different than it was after the earnings, right? Probably not. The concerns regarding artificial intelligence and the like are still there. The investments that companies are making in artificial intelligence, we're talking over $1 trillion at record high interest rates as the economy's sputtering at the moment and maybe in recession, and the Fed is cutting rates, which has never been at this stage, has never been healthy for the market. We may get a couple week push out of the announcement, and maybe that's why the market's getting bid today. Maybe the shorts are covering because of that, but it's never resulted in any sort of massive benefit to the market. Generally speaking, we see further declines once we see that yield curve uninvert, which is what we saw last week. Those are flashing signals of what? Of very potentially large declines in the market. So do you buy Nvidia here? Now, one of the things I walked through last week, and I'll come back to Palantir for just a moment. And again, it's how do you trade something like this? Extreme valuation. The earnings aren't great in terms relative to what price you're paying right now. And so we talked about it. So look, I mean, is there an opportunity? Yeah, it might be a bull flag. We might break out, which we did today. And what we walked through is the idea of buying a spread. The reality is options allow you to do defined risk trades with limited risk and potentially limited or unlimited upside. So last week we walked through the idea for an October expiration, buying a 34 call and selling a 36. Okay. Not a lot of vol skew in here currently, but last week it was pretty flat. It was out of the money, kind of like we saw out here, for example, 38.40, for example, or 38.39. The point being is it was a way to not take the risk because look, this stock is all over the map, gapping down, gapping up, gapping down, gapping up, then reversing after the gap, dropping 20% in a day. Is that the kind of trade you want? Do you want to invest in stock that moves like this? Where, look, you can say technical analysis, but look, clearly nobody knows how to price this stock, right? All these reversals, this little island of reversal right here, gap down, trade gap lower, rally, gap again on the earnings. Nobody knows how to price this stock. So what do? This is where options come in, right? If you could put on a reasonably priced spread to capture the upside, if you want to take that risk. Again, right now, that spread that was out of the money last week is now in the money today. I think we walked through that on Thursday. So it's just one way to trade it. So options provide an ability to trade these kind of stocks because you're taking limited risk with in this case, limited upside potential, but it was pricing fairly well. So the idea is if you're going to take a stab at things, you're looking at some shiny objects, maybe you see an opportunity and you feel it's not just a shiny, it is ingestible. Okay, maybe that's an opportunity. You might look at the options market, look at implied volatility, look at skew, and gauge which spread strategy might be best applied in that particular circumstance. Okay? But anything that's shiny you put in your mouth, that's what a 2-year-old does, right? 1-year-old. They see something that attracts their attention, they put it in their mouth, and ultimately to their detriment. So again, just be careful right now. The conditions of the market are still very volatile and uncertain. And again, we're just on the cusp of Fed rate cuts that, generally speaking, does not produce the upside. Generally speaking, it's a response to downside in the economy, which will pull on stocks. And wait for those opportunities. Again, mentioning Google, right? Cheer the Googles on, right? Sell off, baby. Get down to 130, get down to 120. Look for lower prices as opportunities to buy at a better discount that increases your potential return in the future.